is you don't have to have incredible credit, and the down payments, or actually, I'll take that back. Being able to have to show the income, like traditional bank loans. So there's hope for every real estate investor, especially if you can partner up with people. So long story short, I don't know why this thing keeps going out.
It's just a sleeper. Is that your laptop or hers?
It's mine.
Okay. You know it better than hers.
Yeah. Sorry, guys.
That's okay.
All right. So there's our website, American Financial Lending. So, long story short, we do conventional loans, like everyday primary, like if you're a homeowner. I've been doing that for years and years and years. So there's programs out there to utilize your home as not like an ATM, but you can actually get started as a real estate investor. If you own a home and you have a lot of equity, you have a lot of options there. So without going into that, because I know most of you are into real estate investing, so I just want to focus on that. We do, I'm going to just show you, I'm just going to flip to the other end of it, which is kind of like the presentation. Okay, so it's called Unlocking the Power of Asset-Based Loans. Does anyone here know what an asset-based loan is? Okay, this man here, he's a mortgage broker too. So asset-based is basically lenders are really interested about the property and the equity in it. Okay, so in other words, unlike a traditional bank loan where you've got to show credit, obviously credit's important. You know, I'm not going to take anything away from that. You've got to be able to show income, that you make a certain amount of money, and they use ratios. And you've got to show, obviously, that you've got the down payment to make it happen. And you have to have been on the job for 2 years, typically. They want 2-year history. So we don't care about any of that stuff. We do care about credit, obviously, because if your credit's not, you know, if it's in the 400s, you're not going to get a loan anytime soon. Maybe hard money. So I just want to focus on 2 different products, and I only have 15 minutes, so I'm going to go through this. I'm just getting right to the point, and no small talk here. So the first is, here we go, leveraging DSCR loans. Has anyone here heard of DSCR loans? Okay, so okay, this is good. So this loan's been around for about 2-3 years, give or take, maybe even longer. So it is the most real estate friendly. So if you're a real estate investor, it's the most real estate friendly loan that you can get for 30 or 40 years. So I'm going to take one up on the last guy that was on the, what was it, REL? So he was talking about the 30-year fixed loan. That's actually not the best loan. The best loan on the planet right now is the 40-year interest-only loan. So, which you gave me. He's got 2 loans. Exactly. And why is that? It's simply because the first 10 years are interest-only. So if you live in a high-density area, really, what's the word? Where the purchases are very high, like California, and you're trying to rent out that property, you want an interest-only loan because you want the cash flow. And then if something comes across your table, like a $100,000 lotto that you want, you can pay down your principal by that, and all of a sudden your payment on the following month is instantly lower versus a traditional 30-year fixed. Without going into detail, because that probably sounds complicated, it's a better loan, in my opinion. I've been doing it about 27 years. So, secondly, so you can also, like if you have Airbnb, VRBO, which are really popular, this is the right loan for you. So typically it requires 20% down, and the rates right now, give or take, without paying a lot of points, is roughly in the low 8s. So but you can add the interest-only feature to it, which brings down the payment. Is it worth doing on a really small purchase, like 100 to 200,000? Probably not, but like if you were doing it here, let's say in Santa Barbara, and you have $1 million property, it's definitely worth doing an interest-only. Sorry. All right, so you can cash out up to about 75%. There is less stringent credit requirements. Basically, that means you don't have to show your income, no tax returns, no W-2s, no pay stubs, and we don't verify employment. So on a traditional bank loan, literally right before they fund, they're going to call your employment and make sure you're still working there. We don't do any of that on this type of loan. So we're talking real estate investor loans here versus like owner-occupied. Does that make sense? Everybody on the same page? So DSCR, by the way, it's an acronym. It stands for Debt Service Coverage Ratio. Okay, so it's more of a commercial term. Why they call it that, I don't know, except that that is what they're coined. They're called DSCR loans. They're used to finance rental properties, and which will provide stable cash flow for the landlord. Make sense? And I'll have like maybe a 3 to 5 minute Q&A if you want, like if you want to ask me any questions afterwards. Obviously, there's tax benefits with rental income. You have depreciation. You can depreciate a property over 27.5 years on single family, even longer on commercial properties. But I'm just focusing on like bread and butter 1 to 4 unit is if you're brand new, that's where you want to start. Single family homes, 1 to 4 unit. Unlike a bank loan, so for example, if you're an investor and you can qualify for, with your tax returns, you can only finance up to about 10 properties with a traditional conventional loan. With this type of loan, you can have hundreds of properties. They don't care. That's huge, right? Okay, keep going. Loans, the lowest loan is $100,000. I put up to $3.5 million, but actually I have lenders that can go higher than $3.5 million. But traditionally, most people are going to be somewhere in the $200,000 to $500,000 range. The interest only, notice this last one, interest only 40-10. That is huge. The reason being is the lenders allow you to have an interest-only payment for the first 10 years. Now, some people go, well, I want to pay down my loan. And the reality is you can. You can have the option of just paying the interest only or the interest and principal on a monthly basis. Above and on top of that, you have the option of paying down your principal. So you can make the payment even larger than that. So you have all three going for you. Does that make sense?
Mm-hmm.
Okay, so that is the DSCR loan. That is for, again, short and long-term rentals, right? Typically 1 to 4 unit, but we can actually go up to 8 units. So without going into an apartment loan. Do you guys know what 1 to 4 unit properties are called? Residential properties. They're called multi-units. Once you get into 5+, this is very important in case you're thinking, I want to get more than a 4 unit. When you get into 5+, those are called multifamily, and all the financing criteria changes completely. So that's it for the DSCR. Now let's talk about fix and flip. Do we have any rehabbers here? People that fix and flip properties?
Jeremy.
Okay, Jeremy's outside. So these are huge. So we do a lot of these as well. And the cool thing about these is, one, you don't have to have any experience. You can literally be brand new, as long as you have a partner or something, or have your own money. You can purchase a home. Now, this is what they call it's kind of a hybrid hard money loan. It's basically hard money terms, but they're typically 1 year, interest only for 12 months, and there's no prepayment penalty. So let's say you find a home in, let's use this area, let's say in Santa Barbara, you find a home for $1 million that needs $100,000 worth of rehab, but it's worth $1.5 million at the end of the day. So what the lender is going to look at is the purchase price plus the rehab amount of $100,000 and what they call the ARV, after repaired value. And they use a ratio. So if you're finding a scorching deal, like heavily discounted, guess what? You can get into that property with only 10% down of your own money. Is that cool? So in other words, it levels the playing field for anyone. You just have to find a partner that has that money. You can create an LLC. We normally do all these loans in the LLC, and it's about a 2.5 to 3 week loan. Boom, you've got your money.
Wow.
I'm just going to go through this. Flexible, and the reason it's flexible is because it allows you to make renovations and repairs on this type of loan. Fix and flip, investor, rehab, they're also called, or they are called rehab loans. So it's hard money, but the added component to it is the lender will give you the rehab funds. Now, they don't give it to you on day one. You've got to do some of the work up front. Let's say you do the tile work, and someone will come inspect the tile work, and once he checks off, you can ask for a disbursement, and they will wire the funds to your account typically within a week. So all the rehab, you're getting back. Does that make sense? So it's a phenomenal tool. We have someone from Texas. They do what, 1 to 2 every single month, Joseph, at least. So 1 to 2 every single month, and we close those deals in about 7 to 10 days. So typically these take about 2 to 2.5 weeks to close. It's leveraged, yes. So the biggest thing I can tell you is, if you had $1 million and you tried to do a flip in Santa Barbara and you wanted to do it all cash, you could only do one at a time. But if you had $1 million and you use leveraging through someone like ourselves, you could probably do about 3 at a time, 3 properties all at the same time. So leveraging is the biggest deal in real estate. That's why real estate is so popular, is because you could buy a property that's $1 million with 10% down, typically, especially if it's owner occupied. But in this case, these are rehab loans. The whole purpose is going to be, you're going to get in, and some of you are new, so this is where I'm saying this. You're going to get in at a discount. You're going to partner with a contractor, or you're going to do the work yourself, and you're going to doll up the house and then sell it for a profit, quick profit. So you need this type of loan if that's what you want to do. Right now, the best market, in my opinion, are these rehab loans. Why? They're cash flow. If you buy rentals right now, you better be going out of state for the most part. And there's that man there, talk to him back there. And yeah, exactly. The reason being is the rates are high, right? So they're like in the 8%. So you're going to be more limited on the income that you're bringing in. But if you're doing rehab loans, which you've got to find the properties, then what's going to happen is you're going to have some kind of check coming to you every 3 to 6 months, you know, if you're flipping. You do 3, 4 of those, and then think about a rental, especially if you're new. So no income or employment required. So it's the same kind. It's what they call an asset-based loan. The lenders don't care about your income. They don't care about where you work or if you work. That's cool. On a traditional home loan, you've got to have a 2-year history. If if you can't show a 2-year history of steady employment with little or no gaps, you won't get a loan. But on these type of loans, asset-based, DSCR and rehab loans, you can get the loan irregardless, and these typically close in 2.5 to 3 weeks. So there's the potential for high returns on your investments once you renovate and then resell the property. So what is the goal? The goal is to resell at a profit. That means you've got to know your purchase price, which is obviously the simplest. You've got to know your rehab dollar amount. And how do you know that? You're probably going to have to visit that particular property with your contractor, get a budget. It's called a scope of work. And then that way you know how much it's going to take to bring that property up to date. And then you've got to know what the homes are selling for. If you don't know those 3 numbers, don't do this at all. Do not do this, you're going to lose money. If you know those 3 numbers and you've got, you're partnering with people that are reliable and have high integrity, then it can be a business, a side business for you or a full-time business for a lot of people that get into it and start doing it. This is the short-term investment, can be paid off in less than a year. You can literally get into the property, finish the work in 3 days, which is probably not going to happen, but you can literally have it back selling within the week, and the lender is not going to charge you a prepay penalty. How many of you know what a prepay penalty is? Okay, so basically it's a lender hitting you up for typically 6 months of interest. You know, that's your most traditional prepay penalties. The opportunity to add value. So what you want is you're looking for fixers. You're looking for ugly, run-down, dilapidated homes, basically. The uglier they are in a great area, the happier you are if you find it right at a discount. And loans are typically $100,000 on up. I mean, I think I can get even beyond $4 million. That's pretty much the skinny on it. Moving on. So here's some recent deals besides Dan's here in Santa Barbara. I'm just focusing on Santa Barbara right now. Here's a deal we did in Goleta. It was seasoned local investors, $900,000 purchase price. The loan, well, let me jump into, let me see. How much, what's the rehab on that, Joseph? 160?
190.
Okay, so 190,000 rehab, and forgive me, I missed that on there. They put 10% down, and they sold, the home ARV was 1.35, and we gave them 100% of the rehab funds.
Wow.
Right? So that's the other thing that I didn't really mention. So when you get into these rehab loans, so the big plus is you're typically coming in with 10 to 20% down, depending on how much of a discount you're getting. And the rehab portion, most all our lenders are between 85 to 100%. They'll give you the full, almost the whole rehab amount. Is that cool?
Yeah.
It's nice, huh? The second one here, it's a real estate broker and an investor. So the investor he had the down payment, he partnered with the real estate broker. Right here in Santa Barbara, $1.725 million. They put 15% down, and they didn't have, what do you call it? They couldn't show experience. The way you show experience on these is you've got to be able to show a closed statement with either your name or your company name on it. So in other words, if you're a contractor and you've helped 30 investors and you've done all the work for them, but you can't show one deal that you did in your own name, they won't consider that experience. So in this case, we had to literally go to 3 lenders to get it to the right lender, just because they had a problem with that. And in other words, they were trying to do it with 10% down. We ended up doing it with 15% down. This is the second one. And the ARV I don't know if it's on the market yet, but it's about 2.6 million. So this is leverage. That's what I'm talking about, leverage. And that's the most important thing in real estate. Dallas, Texas, we've got this group. They have it down to a science. You know, they're doing like 1 to 2 every month. We're on our 4th or 5th one with them. We just got introduced to them 2 months ago. And because I've got so much time, I'm going to go down to the next one. So just a tiny bit about us. We're local. We're out of Camarillo. We're boutique. I've been lending since 1996, and the whole real estate, if you want to be successful, is building a team. So financing is obviously a big deal. You know, contractors are a big deal if you're a rehabber. If you're holding on to long-term or short-term rentals, your property manager is a big deal. So, but financing, you need a team. So I consider us an excellent team because we literally quote deals all day long. We quote about 3 to 10 deals a day. So we can give very quick answers, and so you want someone that has experience, obviously. So we offer the latest and greatest high leverage loans. Those two I'm talking about. The other thing we can do is hard money, obviously. Hard money is like a rehab loan, except they don't give you the rehab funds. And typically I have lenders that can go up to 80% on hard money. That hard money is a bridge loan. It's typically when you have to close very quickly and you can't get a bank or a lender to do that. So they serve a purpose. They typically, if you're going to hold on to the property, you get in, you seize it up or you control it, and then you think about refinancing. That's the whole purpose of a hard money loan. We're well versed in owner-occupied and rental loans. I think the advantage to using a mortgage broker versus a direct lender, because I get asked that all the time, is a direct lender is one lender. If something goes wrong in that loan, you're stuck. Your appraisal, you're done. A mortgage broker like us, we can shift the loan to another lender immediately. We can use the same appraisal. So you're better off, in my opinion, with a mortgage broker versus a direct lender, like a one-stop shop. So, having said that, does anyone have any questions at all? I think, is my time almost done? Okay.
Yeah, I had a question about the DSCR loan. Do you have to hit a certain DSCR for the properties that you're needing funding on for them?
Great question. Yes, I didn't cover that. So typically the lenders, to get you the most leverage, like if you're purchasing or refinancing, what they call rate term refinance, to get 80% loan to value, your gross rents have to be equivalent to the mortgage payment, or higher.
Okay.
If they're lower, we could still do the loan. And the only thing is they cut down the loan to value. They cut it down like 5% typically.
Okay.
So, but yeah, the lenders will accommodate for that.
Yeah, so for the rehab fix and flip loan, I think you said the rehab money is not actually included in the loan, like you'll pay for it and then you can be paid on it, is that correct?
So the lenders hold back, it's almost like escrow reserve account, and they base it on this, what they call a scope of work, which is your construction budget, and they'll look at what you allotted for the tile, for example, or the bathrooms, or the plumbing, and that way when you start working on it, you'll do the work for that, and they'll match it based on your spreadsheet. And so once you complete it, you tell them, hey, I want someone to come over and check this out, and you're going to make what they call a draw request. So once that inspector comes over, checks it off, they wire the funds, like ACH typically transfer right into your LLC. And that's the other thing that I didn't mention. Big deal. Most of the lenders on these, they want you to have your title in an LLC or a corporation. So guess what? On a bank loan, like when you buy your house, they do not want that at all. They want it under your name or a trust. So that's a big deal because you can shift that to an entity versus your own name, which gives you another layer of protection, asset protection, when you're in an LLC. Anyone else? Good. Yes,
My
sir.
dad owns on a house that's owned by a retirement plan.
Can you give me an example on that?
Yeah, we own some houses, or 401k owns the houses.
Oh,
So, okay,
okay.
so can you borrow on those?
Possibly. I mean, I'd have to look at that, but get you a very quick answer. I'd like to tell you something. Most of you aren't seniors, but there's actually a way, if you're a senior, to use your home almost like an ATM machine, almost like a social security check. Most people have no clue about this. I only learned it past year. But if you own your home free and clear, through the government, you can get paid about $1,500 to about $2,500 to $3,000 per month for the rest of your life.
Why?
And if you want details on that, see me back there, because I don't want to take more time, but it's incredible. So I'd be happy to tell you about it. Thank you so much. Thank you, Linda.
And he's right about shifting loans around. We were doing mine, and
Thanks, Dan.
they got to the point where they said, "Oh, all the paper was done. We spent weeks and weeks and whatever it seemed like." And they said, "Your daughter is living there in that rental," and it's like, "Yeah, well, we don't do loans if your relative lives in your rental." It's like, what? So we had to, just go to another company. They had all the information. They were able to cut through that real quick. We're good. So Alex is good. We've got probate. We have Paul Wilkins, approved National Insurance Group, insight on probate and real estate investing. And you've got a little something to put in a computer sheet here for you. Okay. And I want to thank you all for hanging in here because I know time's going on and everybody's kind of like, I've almost had enough. But we're getting to the end of this, so hang in there.
I do.
You love it, good. Good, yes.